The wonderful sound of the quintessential Neil Young with his legendary song, Heart of Gold. I'm your host, Brian Hutting, and we have a really special guest with us this evening. But first, let me introduce my co-host, as always, Jonathan Shaw. Jonathan, good evening.
Hello, Brian. I'm very good, and you?
I'm really well, thank you, and very excited to introduce our guest in the form of Tomasz Nadrowski, all the way from New York City. Tomasz, welcome to the show.
Thanks, Brian. Thanks, Jonathan. It's a real pleasure to be introduced with Neil Young's favorite record in my collection, Harvest. So thanks a lot for having me.
It's an absolute pleasure, and only a pleasure to do that. And I thought it would be very appropriate, given a lot of the subject matter we're going to talk around, referring to gold and minerals, that we bring in a song like that.
Oh, is that the theme today? I didn't get it at first.
Almost, it should have been Heart of Neodymium or Heart of Lithium or something like that.
Exactly.
So just a note, for the podcast, if you're listening on the podcast, we do have a new recommended playlist that we're going to put up with the podcast. So if you're listening to this and you check out the description, you'll see all the songs that usually feature in the radio show, but now you can go and listen to them as an aside on the podcast.
Oh, that's great, Jonathan.
Check that out.
I like that little addition. That's fantastic.
Nice.
Tomasz, looking at your very, very compelling and substantial portfolio, there's so many entry points that we could come into with this program. But I'd love to go straight in and hear about your book that you wrote, which is, I think, very exciting. And I'd ask if you'd share that with the listeners.
Sure. The book is entitled Mineral War and subtitled China's Quest for Weapons of Mineral Destruction. And it goes through the history that brought us to this day, which is a very unpleasant present time, where China managed to monopolize several sectors, critical minerals, and then decided to weaponize them. And I tend to dissociate the two processes. Monopolization and weaponization. Now, why did I write the book in the first place? Because I'm sure we're going to come back to that theme in a moment. But I run a portfolio of critical minerals equities here at a fund in New York City. And for a long time, we were not very successful raising new funds from allocators. Most allocators will tell us, well, we don't understand this space. We don't understand those minor metals. It's too complicated. And anyway, China has a monopoly over production. So why would you invest in that? Well, precisely that's why you need to invest in scarcity value. But it's a complex topic. And I decided to basically publish the book. And the next time I hear from allocators, we don't understand the space, I throw the book at them and they have no excuse, right? And they have to invest. So that's the story. On the less frivolous side, I think there is still a disconnect between the way governments think about this strategically and the way Wall Street, or in general capital markets, view it. And the two speak two different languages. I'm fortunate enough to speak more than one language, so I thought I'd translate the Wall Street language into, say, Washington, D.C. language, and vice versa. Language of geopolitics, of geostrategy on one side, and language of margins, IRR, and NPVs on the others. To what extent I've been successful with this, I don't know. It's too early to say. It's still a fresh book, and so I recommend it for as long as we are in 2026. It's still very very topical. But it's important that the two sides understand each other if we are to formulate policies that would lead to some kind of reindustrialization outside of the Chinese value chain, which is not just a challenge for this sector, but I deal with this one on a daily basis. So I thought I'd just contribute with the book.
That's fantastic, and well done in doing so. It brings to mind, funny enough, I was really intrigued to see your interest and involvement with equities in private equity and equities in that space. I found in South Africa, I'd done quite a lot of work with private equity companies, and been interested to see, going back some years now though, how they shied away from commodities. They really didn't want to. They didn't want to play in that space. And I was trying to do some deal origination for them of a really compelling company that was involved in the recycling of carbonaceous waste products from mines, and producing initially predominantly large gold deposits from that, and then other minerals, cobalt and silver and others that they worked in. And it was an incredibly successful business with fantastic profit margins and EBITDA and all those good things. And yet these guys were just not interested. It was so frustrating because it was staring at them, and they just kept coming back to say, no, we're not going to play in that space. And I used to sort of sit there and think, but you guys are in the business of managing risk, and yet you risk averse yourselves. How do you get to marry those two things?
So it's interesting. Well, let me just step back and just refer to what you mentioned about private equity, because it's actually an interesting factor, not limited to South Africa. We observed the same thing here in the US. There was never any interest in the raw materials space. And I think for three reasons. The first one is that most of those funds are closed-end. And so, you start somewhere and you have an exit in X years.
Yeah.
There's no guarantee that in a cyclical market like commodity market, you can actually hit the right spot 7 years from now or whenever, 10 years from now. So that's a big risk. That's the first one. The second thing is that in private equity, when you select the deals, you usually start working with relative value. So you have to have something that's comparable. Say in real estate, it's very simple.
Yes. Yeah.
And some of the venture capital may be less so, but honestly, the geology, as we know, most of the time, even though we look at analogs and trying to compare things, is unique, is idiosyncratic. Every deposit is different. It's very difficult to run very simple RV screens. And the third area is related to duration. Why am I raising this? Because in oil and gas, it is actually possible to have private equity vehicles. Why? Because say in fracking here in the United States, you're in cash in 18 months from now, and then there is a certain flexibility when you have the much smaller footprint and that sort of relatively short duration, which does matter in higher interest rate environment, because the operators can decide, depending on the preferences of their shareholders or LPs, either to pay out a dividend or just start drilling again. Because what is this 18 months or 2 years or 3 years? In mining, on average, we are out there for 15 years stuck in something with very little flexibility, other than maybe sequencing and some modularity of your plant or whatever you can do on the brownfield side. But in reality, we are stuck, and so there, that is not a palatable option, especially in higher interest environment for private equity. So I'm not holding my breath. We are mostly in public equities, listed in all the usual suspect jurisdictions. Although we do look at pre-IPO opportunities, but we have to see the exit. It has to be visible. We're not going to get stuck in something for many years, nor are we able to operate assets. So it has to be a visible exit if we take a position in a private company. But most of those are in the secondary market.
So when you talk public equities, then is their view and behavior more as an investment fund than a private equity fast spin, high growth, high return multiplier?
Well, hopefully high return, but also high risk. The nature of this business is that that's usually, I have to explain this to Americans because I live in a country which is now 70% of the global equity market, right, and growing with the next multi-100 billion IPO and another one. The reality of mining business is that most companies list prematurely, precisely because the only risk capital that's there is really open-ended, not closed-end. And therefore, it's, once you've gone through family and friends round, you just list, in Australia with tens of thousands, hundreds of thousands of shares really on day one. In Canada, maybe less, but this is what happens. From the perspective of the dominant US equity market, this is premature and fairly illiquid, but that's the reality. That's the reality of this space. Unfortunately, between the collapse of the super cycle around 2011 over the next decade till the pandemic and beyond, the professionalized equity fund management business shrank quite significantly. I mean, for South Africa, probably the most important one is the one in London. I mean, really, shrank by about 80% in terms of the funds managed by specialist mining equity funds. In Canada, it's no different. So that's a problem, because then you just don't have sources for financing. And it's extremely difficult for many of these junior operators, whether in South Africa, Australia, Canada, or elsewhere, to take their projects off the ground. And unfortunately, all those different initiatives that I see in the West, just yesterday was the G7 announcement that they're going to cooperate to limit Chinese inputs, or say inputs from one country, as it's stated, to 60% per mineral. Well, that's all good and fine, and there's a lot of effort to promote this industry from upstream to midstream and so on, but it doesn't take into account this pre-existing structure of the sector, and that's my worry, because you cannot really rejuvenate this sector without really taking into account how it's structured in the first place. Maybe because the G7 countries, with the exception of Canada, are not necessarily, those par excellence mining jurisdictions like South Africa, Australia, and some others. So that's a bit of a concern, is that they're trying to reinvent the wheel without really understanding what's behind it. So I hope my book will help some people to understand it better.
That sounds wonderful. And just jumping across back to gold in particular, and we'll talk about that with your experience in South Africa with Anglo Gold Ashanti and your knowledge of the South African landscape, where a lot of our mines here were very deep, and that in that way, that much more expensive to mine. What is the profile of that around the world in other parts of the other geographies in terms of gold mining as a pursuit, and where you're finding the yield and what the cost of getting it is?
Yeah, so as a mining person, I did grow up in South Africa in a way, and growing up means going very deep. So when I then moved to fund management industry and started visiting mines elsewhere, say in Australia, even underground mines, so it was a shock for me. It's not a shaft; you just go in a truck down the ramp. Very, very different story. But this is really an interesting illustration of what has changed in terms of risk appreciation, because my pedigree started at Anglo American's Gold and Uranium division, which became Anglo Gold, which became Anglo Gold Ashanti. But think about that name, Anglo American.
Yes.
What does it mean? This was not an English or American company, but it reflected, a Johannesburg-based company. It reflected the origin of its investors. 100 years ago, the investors were British and American, and therefore, American investors had a completely different risk appreciation, going really deep into South African Witwatersrand belt, or into copper in Chile, right?
Yes.
In exotic jurisdictions. Back then, there was much less compunction against that. That's not the case today. There is this sort of almost instantaneous gratification obsession, and that's not possible in mining, certainly not in deep level mining. So I do think that until 2003, roughly, so the Black Empowerment legislation, there was maybe a chance to connect the South African mining more strongly to the global fund management industry. I don't think it's gone in the right direction ever since, but this is a global problem, not just a South African problem. The risk is considered too high, and just to give you an example, in America, in S&P 500, less than 1% is in mining.
Sure.
And of that 1%, there's only one company that does critical minerals, and that's lithium. So it's insignificant. It's completely invisible in the broader capital market.
I was going to actually ask you that question of the sort of rare earth minerals like erbium and others that seem to be in increasing demand. Where are they coming from, and how does that shape in terms of investment approach and strategy?
Yeah, so this is a really a big topic. So there's 17 of those elements, of which 16 exist in nature, and of those 16, 14 fall into one category called lanthanides. You mentioned erbium, and there's several others. They're predominantly used for magnet production. Why do we care about magnets? Because magnets go into many actuators, including electric motors. So an actuator that has a circular motion. 45% of electricity that we use, mostly in transportation, but not only, uses some form of a motor. So, and without those permanent rare earth magnets, they cannot function. And so now we have one country, there's China, that controls 99% of production of those heavy rare earths, which are important for doping of the magnets that have to perform in high temperature and other hazardous conditions. And that's actually the area which I wouldn't be so concerned about, the monopoly itself. Think about platinum in South Africa, right? South Africa has been a quasi-monopoly in platinum for decades, and it has never been a problem for the global market. The problem starts when a monopoly turns to a weapon, and that's exactly what China has done. And they prepared the ground for this in 2020 with export control law, targeting potentially rare earths and other critical minerals where there's a significant level of monopolization by China. And then over the next 5 to 6 years, they have now fine-tuned this with a number of restrictions that allow them to constrain exports of what they monopolize. And so rare earths fall into this category, and it's extremely dangerous for, say, OEMs around the world, car makers and other producers that need those magnets to produce, whatever. So it's a massive leverage, because the actual value of those oxides, when I looked at it at the beginning of this year, was about $60 billion. That's not so big. However, the translation downstream to the economic value added of the products that cannot do without them is about $10 trillion.
Wow.
$10 trillion.
Wow.
There's a massive chunk of the global GDP. Something like 7% of the global GDP. It could be, see its teeth knocked out if these ingredients are not available. And currently, they're available selectively, because China constrains some of those out of fear that they are for dual use applications. Dual use meaning military and civilian. They're not wrong about it. And that sort of raises an issue of more to a more strategic level. What can we do to actually bypass that chokehold? And there is no straightforward answer to it, but there's a lot of discussion, policy discussion, and indeed the business is seeing some inflows of capital right now to solve this issue and sort of become less dependent on the Chinese flows.
Exactly the question I was going to ask you was the military context. I mean, there must be huge exposure then and dependency in terms of that sits in their hands.
So it's remarkable how quickly we have to learn about these things. When I worked in South Africa in the midst of globalization and the world was beautiful and we could, go to China or Russia and look at potential mine investments, right? This is how the world used to be. I still fondly remember my friend, the head of geology, who had this office in Johannesburg completely plastered with postcards from around the world, which he used to send to his assistant. And we worked together, and we went to a lot of places, very, very exotic places on all continents. Well, that world is over, and partly because we have to learn about conflict, including kinetic conflict, and we're learning really fast. And the best way to learn is just to observe what's going on in Ukraine with the technological change, almost on a monthly basis. There's some kind of overturn of technology that involves a lot of critical minerals, including different rare earths. Just for electromagnetic warfare, you need 2, 3, 4 of different of those rare earth elements. Now, what is electromagnetic warfare? It's the way to basically protect your projectiles against being detected, and vice versa. And gadolinium is super important for Tomahawk missiles that have been used now very profusely in the Persian Gulf War. That's hopefully ended now. Yttrium, another element, non-lanthanide rare earth used in yttrium iron garnet compound that's also part of electromagnetic sort of sensor screening. There are some others. And so scandium, for example, for fuel cells, very useful for those long-range drones. And so that technological advancement in the military sphere, that progresses a lot faster than in civilian sector. Civilian sector is always much larger. For most of these, civilian sector is 90% or more. Maybe now with the growing military budgets around the world, it's changing a little bit, but civilian market is a lot larger. However, the technologies, as Ukraine has proven, change much faster on the military side. That's not new. Think about Second World War. Second World War gave us jets, nuclear weapons, penicillin, and several other inventions that radar that were perfected during the war because it was just so necessary for national security. And we're walking into somewhat similar era right now, where for me as an investor, substitution risk and indeed substitution opportunity is actually a source of potential return. But it's no longer investing in just mining, looking at the drill holes and trying to extrapolate from that and looking at what the resource to reserve conversion will be like. It's more about looking at the entire value chain and including those final end consumer applications. What changes, what kind of scarcity can lead to demand destruction, right? And what can come to replace that? How do we find a proxy for the replacement? And how quickly can we actually identify it and invest in something like this before this alpha goes away from us, because everybody pounces on that. So it's a slightly different ball game, working on an investment in an era of conflict than in the past era of, say, cooperation and competition, which is how I would probably characterize the globalization years of yesteryear.
Tomasz, how would AI factor into this?
It does a lot. So, funny, when we're using our Claudes and ChatGPTs and Geminis and so on, we tend to forget that there's a massive hardware infrastructure behind this. In data centers, of course, and energy that goes into data centers and so on. There is no AI without access to Hsinchu Science Park in Taiwan. Because of just this is the only place where you can actually find 2 nanometer logic chips, smaller than human DNA. And without this, nothing else is possible. So it is absolutely critical to protect that asset for the digital transformation to continue. If something were to happen to Hsinchu Science Park in Taiwan, and I'm not going to go into the details of Taiwan contingency here, but if something were to happen, we will be thrown back about 20 years in terms of technological progress. So it's not a very palatable prospect, hence the vital role of that. Many of these critical minerals end up in that. It's quite astounding when you start looking at how different wafers can be doped and etched and formed in a variety of processes, semiconductor production. There's 60, 70, 75 different elements that go into this. Many of those are those critical minerals that are quasi-monopolized by China. For optoelectronics, for power electronics, for plasma etching, for doping of different materials, just the growing of the different layers on a wafer that's so dependent on compounds built from those minor metals, specialty metals as we call them, that you usually would never hear of, gallium arsenide or indium antimonide and so on and so forth. And they are not mined per se. So you won't find a gallium mine, you won't find an indium mine, but you will find a zinc mine that has a byproduct of indium or germanium, or you will find alumina refinery that has a byproduct of gallium. And the problem that the industry has is that it offered zero payability to these byproducts historically, and now we're highly, highly dependent on that. So that's sort of something that has to change, and this is one of the process of bringing this industry back from China to the free world.
What's so interesting, you talk talking about that, I'm just thinking impact on consumer. So with the shortage of those wafers and the demand for those wafers, that you're finding things like SSD hard drives for keeping your photographs on or your music on or whatever, are the cost of that is it's almost doubled or trebled in the last sort of 9 months to a year.
Yeah, that's mostly affecting memory chips. So we see it in companies in Korea, SK Hynix and Samsung, Micro here in the United States. It just turns out that we need a huge volume of those memory chips. So that was underinvested too. So in a way, part of the technology advances, and then everybody else has to look at like what's missing. So it's interesting, as in 2025, the main story were the designers of this hardware. So say NVIDIA, and now suddenly in 26 realize, well, it's memory chips. In this case, in Korea. So Korean market's extremely volatile, but a very strong upswing on a good day. And then it's as if we're moving slowly upstream, right? Then it's going to be, okay, which components go into those memory chips, and then which elements go into those components or alloys and so on. And so that's actually encouraging if you are investing in materials upstream, because the wave will slowly move this way, and there's nothing in the valuation of these companies upstream that reflects that yet.
Tell me something, taking quite a big turn back to our conversation around South Africa, Santi Gold, and then you exited that in about 2007 to move into hedge fund, which was just pre-stock market crash, global crash. And we were just touching on it briefly before we started our conversation that you had some really interesting observations that and discoveries in that short period of time.
In many ways. So talking about imperfect timing, right?
Yeah.
So I joined a hedge fund late 2007. So of course by early 2009 I was out in the street looking for something new to do. But that was an interesting. It was an interesting lesson. This 2008 was a year that whatever your projections were for oil prices, whether it was $15 or $150, you were correct. It was both of these things. For me, really the lesson was that I just came from looking at projects, say in the DRC, right? But you look at projects in DRC, you spend a lot of time in the forest. You spend a lot of time in forest, in Ituri forest, for example, where unfortunately there's an Ebola outbreak right now. But with Mbuti people, so your mind extends way beyond the squiggles on your Bloomberg screen, and then you're back on the hedge fund trade floor, and you have to flatten all this hands-on knowledge into just two dimensions. And I found this fascinating. That's exactly what we needed to do. Now, 2008 was an unprecedented moment of dislocation, at least here in the U.S. market, and we didn't manage it particularly well. But I remember that foreboding, of this coming, and realizing that the crash is coming, and then looking around me, around the streets of North Carolina, people were completely unaware of what was going on. And let's not forget, this was also a time where we had elections and Obama elections in the United States. So there are other distractions. There was a lot of new hope, as it was stated at that time. But I'd say that sort of cold shower lesson prepared me to look more long term, because ultimately the biggest opportunities that appeared were in early 2009 after the crash for the remaining 2 years of the super cycle. And the problem with this was, however, that if you were on the liquid side of this market, you could maybe time the exit 2 years later. But if you were a mining company, you destroyed shareholder value. Companies just overbuilt, overinvested. There was a massive inflation in the mining sector in 29, 10, 11, and that led to that pullback later on of the Western, say London-listed large mining companies from new projects. They decided to just focus on something that's very predictable, predictable margins, say copper or iron ore in Australia or something like that, and that opened the door for Chinese players to come in, not least to Africa, and just snap up assets little by little, starting with things that are going into steel making, then to base metals, and eventually for critical metals, those that China doesn't have in its own geology, that includes cobalt and manganese. So say the DRC or Gabon, places like that. And since they're coming at zero cost of capital, they prove to be extremely competitive. And the Western mining sector, which used to dominate this industry until 2011, so the end of the super cycle, completely overslept that. And we have seen since then inability of the Western mining industry to compete fully against that very low cost of capital Chinese competition.
So going back to the crash, because it's one of the points I wanted to touch on. My memory of late 2007 and my observations was the big property bubble that was happening in the US. And with my limited knowledge, I was even looking at this and saying, this isn't good. This is just people getting way ahead of themselves. And coming into 2008, when you looked at people like Richard S. Fulk Jr., who was head of Lehman Brothers, who himself was a trader, not a banker, who was completely cavalier and impervious to any nudgings from his colleagues and his peers, and who seemingly played, I don't know to what extent, you've got to look between the lines, how much he contributed to the start of the crash. But the question I wanted to raise was really your observations at that time and even beyond that of the leadership component. What is it that leaders are getting wrong in this whole movie? Be it avarice or greed or megalomania, whatever it might be, and narcissistic stuff, but and traits of hubris. What is it that leaders are missing and could possibly learn from over this period of how we as contributors to the greater world could do it better?
There is a certain cycle between greed and fear throughout the markets, and the regulators tend not to be counter-cyclical in that. So when there's a lot of greed, regulators sort of loosen up on control, and when there's a lot of fear, they tighten up. Lehman Brothers, yes, that's late 2008. I think the first ring was Bear Stearns. I just happened to be at Bear Stearns' office the day before it collapsed in March 2008 here in New York City. And I listened to a presentation regarding commodities, and there was screaming coming out from a room next door. I didn't understand at the time what was going on until I saw the next day people walking out with boxes, leaving the building of Bear Stearns that basically died on that day. The reality is that the lesson, if there is a lesson that regulators learned in 2008, is that they should have bailed out Lehman to prevent the systemic collapse at that point. And that's exactly what has happened since. Think about the COVID intervention, right? Massive intervention, massive liquidity support for about 30 countries that are counterparties of the Fed, just to prevent a massive deflationary shock. Now that, of course, contributed to the inflationary 2020s later on. But I think that's exactly the lesson. Let's say over a long time, there was always this threat. Well, China holds this almost $1 trillion worth of U.S. treasuries, now significantly less, but at some point it was $1 trillion or even more. What's going to happen if they sell it? Well, the Fed during COVID bought, a larger amount within just 2 weeks, right? So in a way, this they believe that this is the role. This is no different to what J.P. Morgan did in the early 1900s. To prevent another deflationary shock back then, before the Fed actually was instituted properly, to avoid a previous crisis, which was highly damaging. So in fact, we always kind of battling the previous crisis or fighting the previous war. But I guess there is more fear of a sudden deflationary shock than of a sudden inflationary dislocation, because we haven't seen a massive jump in inflation that will be as damaging as a complete dislocation in the market, given how the exposure of like general consumer, at least in this country, is to the equity market. And so we had another example of that after the Liberation Day, so-called Liberation Day in April of 2025, when Trump administration announced those tariffs, affecting the entire world, country by country, rather than product by product. And the bond market, of course, reacted very negatively to this, and they had to pull back from the most egregious elements of that plan. So there is a certain, I'd say, discipline in policymaking that's provided by the sector, certainly the bond market. But if the bond market goes haywire, then the equity market will respond accordingly. So in a way, yes, a lot of damage, a lot of wealth destroyed in 2008. But maybe the firepower and the toolkit of the regulators, and especially the Fed, is sufficiently limited to give them, basically that particular weapon, that is to reflate any potential anxiety over another deflationary shock as quickly as possible. And this is what they did during COVID. It's very difficult to judge it over long term. People complain about inflation, but we do not have, next door a laboratory, a lab with a control group to find out how the economy would have performed without that intervention, right? We don't know that, and we will never know this because there's only one planet to work on for now.
And at that time, we saw the big banks, the global banks, take a massive hit in terms of their net asset value and their whole standing. In your observation, did most of them recover from that?
No, I think there were some structural changes that took place, especially after Basel III in the next 2 or 3 years that followed that. And that pulled, for example, a lot of banks from trade financing. And that moved that activity either into the hands of commodity traders, say in Switzerland or Singapore, or indeed for the Chinese entities. And so this traditional work that's so important for the physical movement of commodities around the world, that was largely exited from banks that became more risk averse following the regulatory reaction to the 2008 dislocation crisis. So the banking system was never the same again.
Yeah, I remember at the time before the crash, the merchant banks were riding high, and the individuals in those organizations were being paid commissions that were just off the charts. I mean, it was insane to think that guys could be earning that sort of money,
Talking about imperfect timing again, at that time, so 2004 or 5, I was working at a South African mining company, but I have friends in US who are exactly in the group that you're mentioning, and sometimes, 2 decades later, ask them, so what was your best year in terms of your earnings? Well, 2004, that was really great. Not for me.
No. Going back to the sort of the mining space and looking at the junior mining companies, people going into mining today, what's changed, and what are their big dependencies that they need to manage, and how do they best enter into it?
Which people going into mining today, Brian? I'd like to meet them. There's just not enough. There's not enough geologists, metallurgists, and engineers to take this to the next level.
Is that so? Wow.
Wits University is among the best in the world. That's probably doing a little better. But between Colorado School of Mines and Canada and UK and Australia, it's catastrophic. We just don't have enough people to really take it off the ground and build up this, not just mining, but also smelters and refineries and so on, everything midstream that we need. And that's an industry that's also dying, including in Southern Africa, including, Glencore that's closing smelters in South Africa, and Motsal in Mozambique, and another zinc smelter in Namibia. They just can't compete against Chinese competition that can work at negative margins. And so that prospect is not attracting young people. And it's a real problem. It's a real problem, including in those, par excellence mining jurisdictions. I think if I were asked, what's the number one challenge, is lack of human capital going forward. And that's not a quick fix. No, absolutely not. There's absolutely no quick fix on that. That's a real tragedy. And part of that, it's education failing upon itself. If what sort of
marketing message is being made by the institutions around the possible opportunities for people in that space, because clearly it should bring with it opportunity for people to excel and to prosper if they were to choose that route, provided that the very sectors themselves don't disappear into the ether.
So this is a fascinating conversation, and my book one chapter is entitled "If Greed Doesn't Force Us, Then the Fear Will," and I think this is slowly what's happening to a younger generation. So this year, most offices, including mine, is thinking around with how to best use AI to advance certain processes, modeling, and so on. And we need an intern or 2 interns to do this. But at the end of the day, if we are successful, then it's going to be an AI robot and not a human being. Young people see the writing on the wall, unfortunately, but that also means that going into something that's just a pure manipulation of symbols on a computer screen, which is what you learn in a college, university, is probably not going to guarantee a career. And so increasingly in the United States as well, and it's a system that always existed in Switzerland, to some extent in Germany, you're pushing on people towards something else. Focus on making widgets. Focus on actually creating something that's in 3D, not just on a software screen, so that you learn how to actually catch up with the changing technology, and that you can participate in this process rather than being displaced by this process. And so that means that eventually people will move back to industry. It's not going to be 19th century factory floor or 19th century underground shaft, but it's going to be more people who will have no choice in order to actually have any job other than actually create the world, the 3D world, and that includes mining and metallurgy.
That's quite profound, and I think that it's not something that's that present on front of mind with many young people in the world today and their parents. That they're oblivious to the extent of the changing space of time and what's happening in the world of work.
It's very new. It's just happening for the first time, but they will have to adjust. There's no doubt about it. And we need them. We need them, and the economy will need these people. So people will go where there is a need, and unfortunately, that might mean that maybe, not the gender studies at the university and not critical theory studies, and that's maybe interesting areas, but they're not going to guarantee and not going to be a guarantee for a job in the future.
But isn't there a responsibility with the institutions themselves, academia, to rethink itself and cannibalize itself in terms of what it's offering to the world, rather than something just of academic, esoteric indulgence, to practical, world impacting and value transferring studies?
Well, maybe we need both. Maybe we need really technical apprentissage, so that people actually learn how to make things, physical things. And if they're interested in esoteric side of life and studying philosophy or, practicing religion, that's fine too. That's also another aspect of life. But, we have to make sure that the new generation can also satisfy the economic needs of the system and their own. And that would require some rethinking of the educational system.
Yeah, you've touched on such an important point around the practical hard skills, which we've seen, particularly in South Africa, a complete erosion of. The technical schools and technical colleges closed down, and so we're sitting here with a real need for apprentices and apprenticeships to be reintroduced, and for those skills to be out there, and they're skills that are transferable. You can take them anywhere in the world. A plumber's a plumber. They're going to be needed. They're going to need to fit a pipe, and there's value in that. And similarly with electricians.
Yeah, I think there's still value in making things or fixing things and improving things. And if technology, advances, and we have to say transform plumbing from something to something else, as some of the older towns in Europe have to do, that requires a lot of manpower and skilled manpower. and manpower that's being upskilled on a regular basis, because clean energy and connectivity and wiring and all of these things have to change. If the building is from 19th century, you still have to make it livable. And so there's a lot of potential for that, for both creating new things and maintenance of old things. And there's no way to run against that. That's just the nature of our depreciated capital park. So I think there is no other way. And by the way, we often just agonize about how many engineers are chunked out by, say, China or India or countries like that. They have a similar problem. They're trying to actually provide jobs for graduates. Currently, in China, 20% of graduates are without jobs, and that's before even AI really kicks in. I'm talking about college graduates. So it is a global problem. It's just the fact that many of those symbol manipulating jobs are gonna go away. Is there really a space for paralegals now if Claude can do everything for you for $20? No, there isn't, and there are gonna be more of those. Robotization is gonna change this as well. But this plumbing thing, for many, at least for men, creating something and making something and improving your home and DIY and so on, has been always part of, if not a job, then at least a hobby for many. That's still probably better in terms of skill set and upgrading skills to keep up with technology than just serving coffee to each other, which is what the service industry-based economy has become. Not a very high level of self-esteem. And I think the problems that the US has seen after the China shock of the 2000s under George Bush II presidency led exactly to that. If you travel around, the Dakotas or the Midwest or somewhere, some of the places look like as if Eisenhower was still a president. But people do just that. They serve coffee to each other, and it's not great for self-esteem. So for the next generation to avoid that, we have to actually create the opportunity to actually help them to learn how to make things and how to improve things. And things are in 3D, not things just on a screen, and certainly not on TikTok.
It's absolutely amazing, Tomasz, and so much to reflect on and consider in a world that's become so much more complex than we ever would have imagined. The 20th century was complicated. The 21st century is certainly one that's complex. Just a question, going back, just touching on the mining thing again. If one looks at Africa still is this incredible geography loaded with mineral resources that are profound. What's going to happen with all that unmined that's still out there, and with some of the challenges we've touched on?
Well, that really depends on what the policymakers will do with this in those countries. And, each country has a slightly different attitude. I often hear, like at Indaba this year, that the industry is to go downstream. We really need to build smelters. Really? Where's the energy endowment allowing you to do this? Smelters in the West, that includes Europe, Asia, Australia, Canada, and so on, are struggling. This business is usually low margin, and it has to be high volume. It's very difficult to do this. Maybe at the very early stages of Belt and Road Initiative, where China was actually infusing a lot of funds into Africa, that was the moment to make it conditional upon, building downstream operations. Right now, it's probably nigh on impossible, unless those countries want to become even more dependent on Chinese investment. As you know, this is not coming for free, but a 3.5% interest rate. And that's a problem. That's a problem because that means that currently the capital flows are have been reversed since 24. So this, good $20 billion worth of capital account repayment that goes back to China, in addition to a trade account deficit vis-a-vis China of over $100 billion. And that's because the US and to some extent Europe have shut the door for some of the Chinese products. So rather than China rebalancing its economy from production to consumption, they redirected the edge towards Southeast Asia and Africa, with very damaging consequences for reindustrialization, or in Africa's case, industrialization. But I wouldn't completely agonize about that. It's going to be so difficult to build downstream processing. Maybe in some cases it will be, but overall, it's difficult. We have one example from history of successful downstream building, and economic development on the back of this. That's, of course, De Beers in Botswana. Very, very unique case. But let's not forget that we know countries in developed world that created a lot of wealth just off mining and extraction. Certainly Canada, certainly Norway, certainly Australia. So it's possible to do this. You don't have to invest in smelting, refining, purification, separation, and so on site to extract value from this. It's some kind of a myth that a lot of policymakers in Africa are falling into.
So just talking again about your book, The Mineral War, China's Quest for Weapons of Mineral Destruction. I just love the title. I think it's superb. And where is it available? It's available on Amazon and through various channels. Anybody can get it.
Yeah, anybody can get it from Amazon. That's worldwide. If you're in the US, then of course all other bookstores can hold it too through a wholesaler. But Amazon is the best place around the world to obtain it. It's both available on Kindle and in hard copy.
That's fantastic. Is it on audiobook as well?
Not yet. You're not the first person this week asking for it. So we'll work on that. Yeah.
Okay, that sounds great. Well, I mean, I can't believe it, but we've actually come to the end of the show, and it's been so fascinating. It's been such a pleasure having you join us and be with us and sharing your very substantial insights and wisdom and knowledge and experience with the listeners. And it's just reminded me once again of what a wonderful world we live in. It's crazy. It's upside down, but it's still filled with opportunity and things to learn. And I think one of the most important, perhaps, commodities that people need to hold on to is curiosity and their willingness and ability to learn new things. What would you think on that?
We just see a small snapshot of this, right? That, we are thrown into this at some point. Then we spend 80 years at best in this space, and then we go away. So what else can we offer other than curiosity about what's out there? And we'll never be able to fathom the whole thing. So that's the fascinating thing about this little snapshot of universe and time that
absolutely
we are granted with.
And I think an ever-present gratitude for the fact that we are alive and that we've got another day to either make a difference or not make a difference. But if we can, to just leave a great footprint on the world, no matter how small. And it speaks to how we engage with people and with one another and how we just embrace this thing called life.
That's the healthiest attitude. Yes, absolutely.
That was Tomasz Nadrowski, our guest on our show this week. He's an investment professional. He's an author. He has more than 25 years' experience in the mining and natural resources sectors. Currently serves as a portfolio manager at Amvest Capital, which focuses on critical minerals and commodity strategies. And his recent book that's just gone out there and is available on Amazon is Mineral War, China's Quest for Weapons of Mineral Destruction. He also hosts a podcast called Tyranny Today. Tomasz, I wish you every success in what you're doing. Yeah, thank you. Jono, what are we going out with?
We're going out with John Denver, and Some Days Are Diamonds.
Okay, thank you.
Sticking to mining. Good.
Tomasz, take care, be safe. And listeners, remember, if you're not with the ones you love the ones you're with. Take time to tell and show the ones you love how much you do. And take care of yourselves and each other. Tomasz, all the very best. Thanks for joining us.
Thank you, Brian. Thank you, Jonathan.
Thank you, Tomasz. Have a great day.
Thanks.